Year 2 activity between the parent and the subsidiary. Go ahead and get in front of you the 3-part worksheet for the second year, and we'll start the process of the current year entries under the equity method of accounting. Again, we've got the net income, subsidiary, and the dividends. And you can see from the 3-part worksheet that the net income subsidiary does not agree to the income from sub. And at this point, we see that, and we know that there's going to be some differential adjustments. The question is, what differential adjustments will we have this year? Well, let's start with what we know and kind of follow the same process that we've been doing. The first is the subsidiary's net income of $862,525. So we're going to debit investment sub, credit income from subsidiary for $862,525. Now we know that the difference is going to be the differential items that are amortized. If we start with what we did last year, and I've kind of done this intentionally so that you can know, okay, what's going on. And the 3 things that we had last year: cost of goods sold, depreciation, and goodwill. Well, under the FIFO method, first in, first out, any excess we had was taken care of in the first year whenever we sold it. Depreciation, we'll get to that. But the goodwill, I didn't tell you anything about goodwill impairment in year 2, so there's none for that. So there's none cost of goods sold in year 2, so there's no entry. But there is going to be for depreciation. You remember, we had the estimated useful life of 5 years. So what we're going to do is we're going to record depreciation on that for 5 years. This is the second of the 5th. So we're going to debit income from subsidiary, credit investment subsidiary for $36,400. There is no more impairment loss, so there's no entry there. So we're down to the dividends that we've done several times, and that is going to be debit cash, credit investment for $517,515. And we can see now, when we look at the income, that we can now see how we went from subs net income of $862,525 to income from subsidiary of $826,125. The only adjustment this year was the depreciation. And we'll have this adjustment for X3, X4, and X5. And X6, since we would be fully depreciated, we wouldn't have this. Let's go ahead and go through the same process. Let's do our book value schedule. Remember, the ending balances last year become our beginning balances this year. To that, we add net income minus our dividends. We must also maintain the differential schedule. And this differential schedule works similar to the book value schedule. It is a continuous running balance schedule, so the ending balances at the end of X1 will become the beginning balances for X2. We see from the entry that we've just used one item, which is the depreciation of $36,400. We can still continue reconciling the investment subsidiary account. We've got the beginning balance, any net income, less any dividends, less any differential items, which in this case the only one we had in year 2 was a depreciation. And we see that the investment sub agrees with our reconciliation.